Hey everyone, welcome back to Corporate Decoder, the place to discover the hidden stories within your favorite companies. Filings this report on Launchpad's Streetlight acquisition. Corp tells a tale of aspiration as SPAC looking for its big break, so buckle up because we are about to decode their ambitious plans and the potential pitfalls that come with chasing a dream in the corporate world. Before we dive in, if you love getting straightforward insights from SEC filings, make sure you hit that subscribe button and join our growing community. We have a fantastic Discord server linked in the description below where we break down even more company reports and share trading ideas, so you do not want to miss out. Alright, so what is Launchpad Streetlight Acquisition Corp all about? Well, they are essentially a blank check company, meaning they were formed to acquire another business since they have no actual business operations. Yet their financials look pretty bare bones as of August 2025. They reported a shareholders deficit of negative $15,646 and total assets of only $39,616. But that is standard for a SPAC at this stage. The real story here is about their future plans and the risks that come with them. Their main goal is to raise a significant amount of capital through this proposed public offering. They plan to offer 20 million units at $10 each unit, and if the underwriters decide to sell even more, they could sell up to an additional 3 million units. This money is intended to fund their search for a business to acquire. The company is set to receive a substantial chunk of money from this offering, around $200 million from the units alone, and another $6 million from private placement warrants. This capital is crucial because they only have about $39,000 in assets right now. Their sponsor is also putting in money by buying founder shares for very little cost, meaning they have a lot of skin in the game, but also a huge incentive to make a deal happen. Now let's look at the numbers that really matter for this offering. Without the underwriters selling extra units, they expect to raise $200 million from selling units, and another $6 million from private placement warrants. That totals $206 million before expenses, after paying about $4 million in underwriting discounts, and nearly $1 million in other offering expenses. That leaves them with about $201 million. The big move is Plaque. $200 million of this into a trust account. This is like a safety net for investors, a guarantee that the money will be used for a business acquisition or returned if they fail to find a suitable deal. Let's dig into the dilution aspect, which is super important for investors. The net tangible book value per S-Hair is pretty telling here. After this offering, with all the costs and shares issued, it moves from a slightly negative number to actually quite negative at negative $1.4 per S-Hair in the worst case scenario. This means the initial investors are facing significant dilution right out of the gate. When you look at the dilution percentages, it is quite stark. For instance, in the maximum redemption scenario without the over. Allotment option for the underwriters' dilution is a massive 114%. This happens because the sponsor bought their founder shares for next to nothing, meaning their acquisition cost is incredibly low compared to what public investors are paying. They are likely to make a substantial profit even if the deal does not perform well for the rest of us. The company has founder shares, which are essentially super voting shares for the sponsor. These shares convert to Class A ordinary shares and have anti-dilution protection. This means that if the company issues more shares later to fund a deal, the sponsor's percentage ownership will be protected. This is structured to ensure the sponsor maintains a 20% stake, which is common in SPACs, but it highlights the potential for significant dilution to public shareholders. Launchpad Streetlight Acquisition Corp is facing a ticking clock. They have 24 months to find and complete a business combination, or they have to return the money in the trust account to the shareholders. This tight deadline puts a lot of pressure on the management team, and they might have to take a less than ideal deal just to avoid liquidation. The risk factors read like a laundry list of potential problems, from the inability to find a suitable target to their dependence on a management team that is also juggling other business ventures. Their strategy relies heavily on the extensive network of their management team and advisors. They believe this network will provide a steady flow of investment opportunities from various sources, including other investment bankers and private equity funds. This is a common SPAC strategy, but it is also a significant dependency. If this network does not yield a good opportunity, they could be in trouble. There are definitely some potential conflicts of interest here. The sponsor and company insiders own founder shares and private placement warrants, meaning they have a financial incentive to complete any deal, even if it is not the best for public shareholders. Additionally, some of their officers and directors have duties to other entities, which could mean they prioritize other opportunities. This is a serious concern for any investor or looking at this deal. The deal structure itself is interesting. Each unit gives you one Class A ordinary share and only half a warrant. This is designed to reduce dilution from warrants compared to other SPACs that give you a full warrant per unit. However, it also means each unit might be worth less than similar units from other SPACs. They think this makes them a more attractive partner for potential acquisition targets. Looking at the financial tables, again, the net tangible book value Per share after the offering is actually negative $1.4, assuming maximum redemptions. This is a big indicator of dilution and the significant impact of the founder shares purchased at a nominal price. The market price also has to clear a certain threshold before warrants are even attractive to redeem, making their value quite uncertain. In terms of financial condition and results of operations, Launchpad Streetlight Acquisition Corp has virtually none to speak of as of August 2025. They've incurred some general and administrative expenses primarily for formation and offering costs totaling $15,646. But this is all pre-operation and pre-acquisition. The real story is what happens with the money from the offering. They plan to use about $750,000 of the offering proceeds for various expenses. Like legal, accounting, and administrative costs, this leaves a substantial amount to go into the trust account for the actual business combination. The key takeaway here is that most of the money is locked up until a deal is found. The auditors have issued a clear warning here. They state there is substantial doubt about Launchpad Streetlight Acquisition Corp's ability to continue as a going concern. This is because they have no cash and limited working capital outside of the proposed offering. This is a standard disclaimer for SPACs before they raise capital, but it underscores how critical this offering is to their survival. The actual net loss for the period presented is $15,646. This is directly related to their general and administrative expenses. Before they even begin operations, this number will obviously change dramatically once they start acquiring a business. So what is the story here? Launchpad Streetlight Acquisition Corp is a SPAC with a seasoned management team eager to find a target largely in the hospitality sector. The challenge they face is immense. They have a tight deadline, significant dilution from founder shares, and a host of potential conflicts of interest. Their reliance on their network is a double-edged sword. It could lead to great deals or leave them scrambling financially. They are starting from scratch with a huge chunk of investor money being held in trust that diluted. Per share book value is a stark reminder of the sponsor's initial advantageous position. The biggest risks are obvious: not finding a deal within the 24-month window and the potential conflicts of interest that could lead to a deal that is not in public shareholders' best interest. Their redemption structure and the potential for cashless warrant exercises add further layers of complexity for new investors. Ultimately, Launchpad Streetlight Acquisition Corp is a gamble on their management team's ability to execute a successful acquisition. In a competitive market, the financials they've presented so far are just the beginning. The real test will be what they do with the capital they raise and the deal they eventually strike. What is your take on Launchpad Streetlight Acquisition Corp and their ambitious plans for a business combination? Let us know in the comments below. If you found this deep dive valuable, please give this video a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community linked in the description below for more insights and discussions. Thanks for watching. See you next time.